All right, what an intraday swing we had today. It was looking pretty dire this morning, and then the rally was significant. It was strong. It was sharp. Was it enough? Did we have enough of a drop to actually be a correction? Was it enough of a rally today to halt the correction? Or is this all just noise? And we really haven't had a move one way or the other yet in either regard. So I'm going to break that down in our technical analysis in our video today. Excuse me, market outlook video today. We're also going to break down the kind of moves that you get. Why today. Why today's rally is not that surprising, even if you are bearish. How prevalent these types of moves are during pullbacks, like we are already getting in the NASDAQ 100, even if we're not necessarily getting it on the other indicators or indexes. At least we weren't until the end of this week. So I'm going to break all that down in today's video, and then we're also going to talk about a stock from a sector that's been kind of the picture or poster child of the volatility we're getting, especially in the tech area. We're going to talk about how we trade its volatility that we would expect to now start to simmer down a little bit. What kind of trade we can make with that perspective. So let's go ahead and get started. Today is Friday, March the 5th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicators, we always do. And you can see the rally we had off of the low, very strong rally, very big range today, 121.5 points versus 120 points yesterday. Big ranges, you'll see here in a second. Brought the short-term sentiment lines up from oversold levels, both of them coming up. The momentum line coming up from extreme low, the near-term line coming up from its lowest low point it's hit since we started the intermediate rally. Not getting back above the moving average today. We'll talk more about that here in just a second. But we do have, the intermediate line did turn back up. It's back to dark green shading. We do have a red line, so it's not, we're not still back to a bullish trend. But we also haven't started the pullback yet either. You notice we got below this is just a sniff below the 23% moving average or 23% Fibonacci level, but then jumped about as much as we were here. Because remember, this got just barely below at that level. Just to remind you here, let me activate this and bring this down to what was. You can see how on that day we had closed just a smidgen below it as well. Didn't quite have the same bearish short-term sentiment, but just a smidgen below that, and you can see we have it again. And this one's a little different in that now we do have a red line. So that's what throws into question today's rally, whether or not that's actually a legitimate bullish move and we're back going again here, or if it's just kind of a sucker type rally. If you take a look at the Dow's not even close to starting an intermediate pullback yet. It's actually back to dark green shading and a green line again, just like that. And market sentiments is barely falling below 80. The NASDAQ 100 didn't even get back above its 38% Fibonacci retracement today. So that just kind of shows how bearish it was. In fact, the NASDAQ 100 got all the way down to its 23% level of the long-term move. Nothing else is even close to that. Look at the S&P. The equivalent level on the S&P would be way down here, and we're not anywhere close to that. And then you look at the Russell, the equivalent level for the Russell would be down to this level too, and we're not below that or the 23% level of this current intermediate run. So we are still below the moving average, however, after breaking pretty sharply below it yesterday. And again, you get the strong short-term sentiment and it bounces, but the question is, are we going to bounce up to a bullish near-term high or not? As of right now, the Russell's not showing that per se, and the S&P is barely above 50, and the NASDAQ is still well below 40. So that's not necessarily the case. The intermediate line for the S&P did not drop below 50, much less 40. It is below 60, so it kind of suggests that we're not strongly bullish anymore, but you're also kind of in this neutral range between 40 and 60 where you're not really bearish yet either. All right, because that's when you get below 40 there. And you can see for the Dow Jones actually still is above 60, so it is still is showing a strong trend, and we saw that before. The NASDAQ is well below 40, again confirming that we are actually in an intermediate pullback on the NASDAQ, even if we're not on all the other indexes. And then, of course, barely below 60 on the Russell, again suggesting we're not strongly bullish anymore, but we're also not bearish yet either. So that kind of gives us an idea there. And this is the end of the week. So let's take a look at how the weekly charts look like. So let's just go to a 5-year chart. So here's our market forecast. Again, you can see strong bullish posture, well above the moving average. Dark green shading, green line. The near-term line's dropping, but it's not down to any kind of extreme low. The momentum line's not down to any kind of extreme low. So nothing really too concerning. We did get a pretty deep drop the last 2 weeks on the momentum line, but today's bounce off of its lows pushed the momentum line higher and brought the near-term line down. So from this perspective, if you look at this as kind of an intermediate rally, the near-term line getting on the market on the daily chart, if you kind of correspond the blue line here with the green line on the daily chart, the blue line has fallen below 50. So we'll see. You can see this intermediate pullback here. The near-term line had dropped below 50. It actually had dropped below 50 during that pullback too, and that was not an intermediate pullback at the time. And you can see some of the other instances where it got below 50. So, are we going to turn into something like this, where we did get a pretty decent pullback, and that also corresponded with oversold momentum lines, just like this one? Or is it going to look like this one, where we got about as close as we could to a pullback without getting one? The near-term line dropped below 50, but we never got any extreme lows. In fact, these are both intermediate confirmation signals, and you can see how we bounced off of both of them. We didn't bounce off of these intermediate confirmation signals the last 2 weeks, and this week we only bounced up because of, and we actually finished the week higher, but we only bounced up because of a sharp move off of the lows today, the last so many hours of the trading session. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, click the thumbs up icon. That lets us know 2 things: that you liked our video today and that you want us to do another video again next week on Monday. Quick way to give us feedback: if you don't like our videos, of course, you don't have to watch. If you do like our videos and you want to let us know, do it with 1 click right now while you're watching down there. Also, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those in the comment section. Follow me on Twitter for more, join our website, at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right here at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching us on our blog, there's these other things over here on the right. Check some of these things out. Click here. That takes you to our Market Outlook live video. This is for all of our premium and our plus subscribers. This is every day I do the Market Outlook. I also do a live video earlier in the day at 3:30 Eastern time. I take a look at all the trades we've discussed in these different Market Outlook videos. We trade and we close any of them that we need to. We talk about how we're managing the others all the way up until we close. So it's a really big deal to me, and a lot of people will talk about you can buy this, you can buy that. We go beyond. We talk about how to manage the risk of the trade using our class portfolio as an example. We talk about when we get out of the trade and why. So that's what we continue to follow up on the trade ideas from these market outlooks in this particular video here. Also, you can see the upcoming classes that we have. My Q&A session tomorrow morning is for our premium subscribers, but all the other trading rooms are for both, all of our monthly and our premium subscribers there. So that kind of gives you an idea of what we have to offer. Come down here, click on that heart. It opens up a new tab. Hit that like button right there. Hit this thumbs up icon, opens up another new tab. Hit that like button as well. Again, the more you do that, it helps us because more of our content will get. You can see what we eat as a family a lot here. More of our content can get to more of our followers. So that helps us. The more you like and comment and retweet, you can retweet from right here as well. So that benefits us, but it also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, so I want to talk about what I mentioned to you just a second ago about the S&P being below its 30-day moving average, and how that impacts the kind of moves you get. So if you take a look at the rate of change, I'm just going to look at the one-day rate of change. I talked about this today in my technical analysis class. Let me bring this over here to green and to green. Oops, not to pink, green. All right, so if you look at the one-day rate of change, when you are below the 30-day moving average. So here, let's just go to, we'll zoom in on this time where you're on this bullish intermediate run and then you're below the moving average. You'll notice here that you tend to get, and when you're on this intermediate pullback, there's almost as many up days as there are down days. So when you're in intermediate declines, because this one took a couple of months before we really got going again on the on this particular intermediate rally, right? So during this 2 months of this intermediate decline, we had almost as many up days as we had down days. But you also notice that, when we were below the moving average, our up days were actually bigger than our up days during the bullish run were. The example I showed here today was back to that 2018, the fourth quarter, this period right here. So if you look at this period, you'll notice again, good bullish run, not a whole lot of, there's about as high as our intermediate. You can see down at the bottom, the highs when you're above the moving average, how big your up moves are, how big, a percentage moves your daily. And you can see my cursor is right about less than 1%. But now look over to the right, and again, you can see during the decline, while we were below the moving average, we didn't go down every single day. In fact, there's quite a few up days mixed in with all those down days over on the right half of the chart during the intermediate decline while we were below the 30-day moving average. And if you also notice, relative to the horizontal line I've got drawn, they were bigger up days than during this bullish move on the left half of the chart when we were on a bullish intermediate run. So just because we might be, even in the beginnings right now of an intermediate pullback, just because we get up days and we get significantly higher up days, just know that, we get our up days when, the biggest up days when we are below the moving average. We were below the moving average here and we got, boom, a bigger up day than we had all during the bullish intermediate run, right? And again, today, we had a bigger up day on the S&P because we were below, and we're actually still below it. But yesterday we closed below the 30-day moving average, so we had a bigger up day than we had all during this whole bullish run. We didn't have a single bigger up day above the 30-day moving average than we did when we were below it. And you can see over here, again, even up to this point, when we were below the moving average that one day, we had one of the bigger up days that we had during that whole period. So, again, it goes to show that, number one, when you are in intermediate pullbacks, and the same holds true for the NASDAQ. Remember, the NASDAQ actually is in an intermediate decline right now. So if I were to zoom out and just kind of zoom in on this current period, so there's, an up day, and you can see, if I put my cursor right on that up day, there was no bullish move. There was no up day during the bullish intermediate rally that was bigger than that up day on March the 1st when we were below the moving average and we bounced, right? And you can see some of these other, you can see how much we bounced off of the low. So even though today wasn't very big off of yesterday's close, it was obviously pretty big off of this morning's low. So we're getting big moves because we're below the moving average. And so I want to dispel this idea that when we are bearish, when we are in intermediate pullback mode, like we are on the NASDAQ, we might not be on the S&P yet, but we are on the NASDAQ for sure. When we are in this intermediate pullback mode, it doesn't mean that every day is a down day. In fact, we get, as we saw, we get as many up days as down days during intermediate pullbacks. And it doesn't mean that when we do get an up day that they're just barely up because they're fighting so hard against this bearish momentum. No, we get the biggest up days during the bearish runs. We get bigger up days during the bearish runs than we do during the bullish runs. So get out of your mind this thought of when we're bearish, we're always bearish, and we are nothing but bearish, right? When we're bearish, it just means we're volatile. We're going to have down days and up days. And we're going to have big down days. And we're going to have bigger up days. So when you have a big up day, when you're below the moving average, just remember that that's how it works. It doesn't mean that, we're done now and the bears are done. It could be, for all we know. But in and of itself, it doesn't mean that. we could go down, we could have up and down all throughout next week. In fact, I would kind of lean towards that because, like I said, the Nasdaq has already officially entered intermediate pullback mode. Did not bounce back up above its 23%, much the 38% Fibonacci line, much less the 23%. So it's nowhere near recovering from what is now actually a pullback. And I still think we still have room to go to see the S&P and then the Russell, which has a lot more room to pull back and doesn't have a whole lot of support because it's moved up so fast here lately. Once it starts to exhale, it will take over the reins. It will take over the exhale leadership from these Nasdaq 100 stocks when it really gets going to the downside. And you can see that here, especially in the Bollinger Bands. You can see on IWM how there's just not, once you break this level, this 23% level, there's not a lot of volume down there. A little bit here at the 23% retracement, 38% of the intermediate rally, but nothing all the way down. In fact, I would not be surprised if it came down here. Again, worst case scenario. Best case scenario is it stops here at 200. Worst case scenario is it comes down towards this 165 area. So those are some key, because again, very, very little volume support. On the other hand, the Qs, again, you can see how much volume support it has. Like it's down here. There's a reason why it's kind of stalling at 300 because there is a lot of volume down below that. And again, that's your best case scenario, and we've already hit it. Worst case scenario is we grind our way down through all this slug of volume down to this 275 area where the point of control is, where the 38% Fibonacci retracement level is of the long-term run. That one is going to be an insanely strong support level, and if we happen to touch it, an insanely awesome buying opportunity. All right, so now let's take a look at like the 3 green arrows chart, and you can see we got a green arrow on the stochastic. Still a lot of volume you see down there. Look at the 2-line versions. We are not back above the 17. As bullish as this rally was, keep in mind that we were that far away from the 8-day moving average. It's really hard to stay that far away from the 8-day moving average. You tend to kind of, especially on the downside, come back up to it. But we are still at it. We didn't cross above the 17-day. Both the 8 and the 17-day have crossed below the 30. The moving average for the MACD, even if the MACD is rising, the moving average is still falling, crossing below 0. The moving average for the stochastics, even though the stochastics crossed above it at least briefly, the moving average itself is already crossed below 50 and is close to crossing below 40, which would be bearish, right? That would be the equivalent of crossing below 0 here on the MACD. So, that we're not out of the woods at all, hardly at all here. You look at the DMI, and we still have a very bearish pattern with a rising ADX. In fact, that's the other thing I brought up today in class, that the ADX for the NASDAQ is crossing above 25. Again, the last time we saw this pattern where the ADX was bearish during an intermediate pullback without the intermediate run making the strong move higher previously, you have to go back to that 2018 period, right in here. In 2018, we had this good, strong intermediate rally without a strong bullish move. The ADX was down below 20 that entire time, and then it rose during the bearish move, and you can see it kept us there. Because of that, it kept us there for a little bit longer. So that's the type of multi-month pullback. Again, keep in mind that the worst of that pullback occurred at the very, very end, and that didn't last very long. It recovered. So disregard that kind of selling that didn't last very long. It was related to tweets and the Fed came out with said that, I can't remember if they were like they weren't going to cut rates again, or they came out and said something. They quickly backtracked off of that, and then again, like I said, there was also trade tweets during that period of time as well. But really, that pullback most of that pullback was right here. Again, multi-month pullback, and that's the kind of pullback I expect that we'll eventually get over here once the S&P and the Russell start. But like I said, the S&P hasn't. The ADX is rising, but hasn't crossed above 20 yet. IWM. The ADX had just finished a really strong bullish move, and it's now starting to rise back up above 20. So, it hasn't really made its run yet up above 20 or 25 again, like what we're seeing in the Qs, which again is another reason why I think that we are in this bear that this is going to bleed itself over into these other areas. We'll see a more broader pullback in the next few weeks. Looking at the long-term chart, you can see the bearish candle. Next week's candle is going to start off at about 38.55 or so. We're at 38.41 right now. So depending upon how and where we open on Monday, we're going to start off with a bearish candle again. And considering how high the PPO is, a lot of times we tend to fill in the gaps between the 50 and the 200-day moving average during this type of pullback. Again, that would pretty much get us down towards that 23% retracement if that were to happen. On the NASDAQ, which remember is already in its pullback mode, right? Getting a lot more bearish candle, no upper shadow, a lower low. Didn't get a lower close, but we got a lower low, and you can see how it got down, and its 200-day moving average is sitting on the 38% retracement. The Russell, same thing. Its 200-day moving average would be sitting down there too. So that's why I say those two probably have more of an opportunity to drop that far, more so than the S&P does. The S&P more likely will stop right around that 23% level, maybe in between, but probably will stop in that area because that's where its 200-day moving average will be if we do fall down and when we are to touch that 200-day moving average, if it were to touch it as well during the pullback. All right, really quickly, let's take a look at the intraday charts here, and you can see the rally up to, again, resistance area. I've told you before, when there's very little volume, you can go down, you can go up, you can go down, you can go up very, very quickly. And we've seen that in the last 2 days. Big, fast moves to the downside, fast bounces, and then a fast bounce to close today. And again, we're back at a resistance level. How likely are we to hold at that resistance level? That's the question. And you would expect that we would until we don't. Right? You expect resistance to hold until it doesn't. You can see the Qs didn't quite bounce up as much, and it's got a lot of room to go to really turn things around. I drew the Fibonacci lines on the pullback on this last couple of, since we started the drop there on Monday. So you can see the S&P not only got to that volume resistance, but to the top of the Fibonacci retracement zone at that 62%. So very good chance that even if we, depending upon how much we maybe gap up on Monday morning, but very good chance that we might have hit our head up against the ceiling here today, and we'll fill in, a lot of that volume again. Again, very, very easy to fall down there because there's not very much volume. And then I mentioned to you in Friday's video, the other bearish sign is the fact that this Arun indicator has turned as bearish as it is, right? We have, the red line is above the green. That we're not going to get a new high point anytime soon unless we really take off with some catalyst over the weekend. So the red line's got it to high levels. It's above the green line. It's above there for multiple days. So, again, that's very typical of intermediate pullbacks. Let's take a look at the volatility lastly, and then we'll summarize our outlook here. We did have a pullback. Again, as of right now, potentially a higher low. We did get an equal high here instead of a higher high. So we'll see if we end up getting a higher low. Now that we're, instead of using the 80%, a little bit below 80 and the 85, and now we're potentially using the 90% as a low point as to where we might bounce up next. And again, 105% is the level of where you say, okay, we've jumped up enough to where we can, we are starting an intermediate pullback that may not go down very much more in terms of price, but may stay down for another, 6 to 8 weeks or so. All right, so to summarize my technical outlook, again, we've been anticipating this kind of pullback for the last, we've been in the mature intermediate run for the last so many weeks. Some kind of pullback, the environment was setting itself up for that type of move. We actually did get it in the NASDAQ 100, and we've seen how bearish that's been. It has not bled itself over. There's been some, yesterday and today at the lows on the S&P, you could say that we had now started intermediate pullback mode in a lot of different indicators. But because we didn't close there and we rallied both days, it's kept us from being able to say we're in pullback mode, right? So, but you see how close and how tenuous it is. And like I said on Wednesday's video, we've had a lot of opportunities to de-risk, right? The market has been telling us for the last couple of weeks, that things are a little bit more bearish. And it's been more bearish in some areas than others. But from a broad standpoint, it's been kind of giving us a plenty of forewarning that something is coming. So if things do get a little bit more hairy next week, then we have nobody to blame if we're still very aggressively bullish. And it ends up being a very painful experience because we've had a lot of warning. On the other hand, if we bounce back up, again, it shows the importance of closing values, and we will still be in a mature, bullish, intermediate run. So we can get another near-term run or two. I've told you before, when you're in mature runs, we tend to get more frequent, and near-term rallies, they don't last as long. They last less than average. So, if we end up being bullish next week, that's the kind of environment I expect us to go into. We would not be back to being bullish on the NASDAQ. We would still be in pullback mode. So if our rally next week is able to maintain the mature bullish trend in the other indexes without re-engaging a new bullish trend in the NASDAQ, then we know we have, again, this golden opportunity to de-risk on an upswing before there's more of a downswing. So what do you think? Do you agree with that? Do you disagree? Let me know in the comments section down below, especially if you disagree. What charts or indicators are you looking at that suggest why you're either a lot more bullish than I am right now, or that you're a lot more bearish than I am right now? All right, now let's take a look at what's driving the price action today. And let's just take a look at today alone first, and we can see kind of the up and the downward move, right? So let's go over to just today right here, and there we go, 5 minutes. So commodities started off strong and ended up strong by the end of the day. Look at small caps. Look at the big swing. They went from the lowest, the worst performer of the day, 2.5% decline at the low point, and then finishing the day with a 2% rally. So that's quite the turnaround. And again, that's a pretty significant move, and it wasn't necessarily, closing here at the close, and then you had this rally here. But you can see you get big moves to the upside when you're below moving averages, and the Russell's not even below its moving average, not like the Qs are, and the Qs were down and made a pretty decent rally too, though they outperformed to the downside, but then really lagged on the upside as the IWM took off. And of course, that's continuing to have an impact on this chart. This chart here, let's update this one. You can see the relative strength is still pretty darn bearish, but it came off of its lows today. But you can see down from yesterday. So we're still, the Russell, the relative strength is still bearish, but you're getting a little bit of a hammer pattern here on the relative strength line. We'll see if that ends up turning into something that ends up being more bullish for the Qs, and we just haven't had that transition yet. But once we do start to make that transition again, as you saw here, when we are bearish, it will be these small cap stocks that are the most bearish. If I just go back the last few days here to look at the selling of the last so many days, again, you can see small caps and the Qs both selling off pretty hard. Qs initially, but then small caps joining the party in the last couple of days, really down quite a bit, even with commodities. And look at that strong move higher in the dollar. The dollar index continues to show some very strong moves to the upside. Again, not trending moves, right? But the fact that it's still in intermediate decline, you can see how long they can last. Where this is as long as we're going, we're at the bottom of the Fibonacci retracement zone. I've kind of mentioned before that I think there's still an opportunity for us to hit that 78% as we get a broader move in risk aversion. But it again kind of shows just how bullish the dollar is, and how much pressure that's putting on the NASDAQ, even if it's not putting a lot of pressure yet on all the other major indexes. The 10-year yield is what's driving a lot of the craziness as well in terms of risk-off moves. But that's not typical either. Usually yields that are rising don't lead to stocks falling because usually, again, it's an either-or trade, right? You're either going into stocks or you're going into bonds. But I will say that the 10-year yield, relative to its 30-day moving average, so let's pull this up here, just to kind of show you just how bullish that yield is here. 30, and then simple. And let's go out like 5 years. So in the last 5 years, we are in the 91st percentile of how bullish that yield was. The only time it's been higher than this is back over right there in June of 2020, which was a brief spike. This has been more of a steady decline during a bullish intermediate run that appears to be kind of going parabolic. You kind of saw that here. We went parabolic and then finished with the divergence, and then then it really couldn't go anywhere. And I think I've shown you this chart in this video before of the rate of change for TNX, and again, very, very high levels for the rate of change. You go back to 2016, that was a high level, right about where we're at here, a little bit lower, in the just above 60s. You can see in 2013 during the height of QE3, a very similar peak that we had some volatility with, some ups and downs. Of course, 2011, right before the credit downgrade, you can see how high some of these peaks were. And then what happened, the deals after those peaks. So we are obviously forming a peak now, as bullish as we've been. And the question now is, have we gone up too far, too fast? In the past, that has been kind of a pause for bonds. It doesn't mean necessarily we have to go down. You notice this one didn't go down to new lower lows, and we actually ended up trending back higher again after that. Could we get that type of move and maybe not last as long, but over a couple of months here as we come back down towards this 23% line and then work our way maybe even down towards 1%, but most likely into this 1.2, a little bit lower level, and then work our way back up and break back out towards 2.25%, which is where I ultimately think that will go if we were to do this kind of pullback and that kind of rally. That's the kind of move I expect would take us up towards that 2% level, considering how high inflation expectations already are. All right, now let's take a look at the sector rotations today. So we'll do a sector comparison, and just for today alone, again, during this round trip, right, that we had, you saw small caps performed. Well, during the week, the worst part of the day, discretionaries really came down, again, really hurt by like Tesla. Tesla really putting some pressure on this market cap weighted index. You see that energy was your best performer, aside from that brief period where Staples outperformed it for most of the day, up almost 4% on the day during, never went negative during the day. And you can see discretionary technology all kind of lagging behind, along with these interest rate sensitive areas on both sides of the interest rate sensitive move, both financials and real estate and utilities lagging behind the broader market. Utilities actually was outpacing for a brief period of time before pulling back there at the end. So you take a look at the 12 grid and how the week ended up here for these sectors, and again, look at the technology and discretionary. Those don't look like sectors that are about to turn higher on dark green shading and green lines anytime soon. And again, as far below the moving average that they are, you will get your biggest moves down below the moving average. And we see that in healthcare, we see that in staples, we see that in utilities. There's a lot of these sectors that are currently below falling moving averages right now. Even if your kind of dollar sensitive and interest rate sensitive areas are still bullish. But with the dollar rising, that's going to put some pressure on these areas, especially like the energy sector, which has really blown up. I don't think that the energy sector will downtrend, but I think you'll get an exhale from such a strong move higher that will again lead to or coincide with the shift back to the upside here. Remember, the shift to the upside on this particular ratio will not coincide with a bullish market. It will coincide with that bearish intermediate pullback, and then continue upwards, in my opinion, once we get our bounce and a new intermediate run starts. All right, and that takes us to our trade idea of the day, and it's been a poster child of the volatility that we've seen in these large cap tech areas, and that is Intel. It's actually in a sector that's a poster child, and you can see my trade actually didn't go through before the market closed, so I still have an order through for Monday. But a nice little bounce off of a low point there. We've been bullish. The market forecast line came down, hits moving average market sentiment, just like it did before, has a potential to rally here, but also could come back down as well. But the nice thing that kind of stands out to me from a Bollinger Band perspective, we are right in the middle of the bandwidth. Right, we close right in the middle of the bandwidth. The bandwidth is falling, and we're kind of centering around a pretty significant volume node. Not the point of control, though that may shift as by the time we get to March expiration and all these days come off. We're going to lose some volume in that area, but we are centering around a pretty significant volume node with falling bandwidth. If you look at the ADX, which has been very, very strong, it's been falling and is working its way back down. As you see, the positive and the negative index are sitting right on top of each other. You take a look at the trend strength indicator, and you can see we had a really strong bullish trend. It's gone now. There's no trend. It's very noisy. There's no trend. So when I see stuff like that, I think, oh, I had a really strong trend and now I don't. Then I'm going to sell the 20 deltas on both sides. I'm going to sell the 55 put, buy the 52.5 for protection. So it looks like this. I'm going to sell the 67.5 put, buy the 70 for protection. And you can see a little bit tighter spreads when the markets are open. But that's kind of what we're shooting for, is that 68 cent, 70 cent spread. Position sizing around a full maximum because earnings will be after April expiration, and trying to get a pretty decent reward for the amount of risk that we're willing to take. And those lines are these blue lines. So that's how much it can go up and we'd still be okay. This is how far it can go down to basically to the bottom of the cloud and still be okay there. And you can see multiple touches in that particular area to the downside that can offer an area of support. All right, so you've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there or reply to anybody else's thread. It's a message board, so let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on our video down below. Follow me on Twitter for more content. Join our Facebook group that I showed you previously. Have a great rest of your weekend, everybody. Nice spring March weekend. We'll see you all next week.